We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lyn Alden, founder of Lyn Alden Investment Strategy. Thanks for joining me today, Lyn.
Thanks for having me back on.
Excellent to have you. So, considering the inflation narrative that we've been hearing constantly, do you think that some of it has been masked by the supply chain shortages that we've seen?
Well, masked and caused by, in part. So it's kind of multiple things there. So in short, I would say basically last year and still going into this year, we dramatically increased the amount of money supply out there, and that's just not just bank reserves. That's actual people's deposits. Because it wasn't just QE, it was QE plus fiscal stimulus that actually got out to people. So we basically increased people's ability to spend and purchase things while not increasing the supply of those goods and services in the most case. In some cases, we actually reduced them. And so it's natural that we ran into this issue, especially when you combine it with complex global supply chains that spent the past 25 years being more and more efficient and less resilient. So I think I like to flip the question on its head because people are like, why are prices going so much right now? And it's like, well, they were only low as they were over the past, especially, 10, 20 years, because we basically had all that disinflationary force of like constant globalization. And we've if you look at, say, global trade as a percentage of global GDP, that peaked back in 2008, 2009, and it's been going sideways ever since. So we had this long period of globalization, and then we're kind of consolidating with the amount of globalization that we have. And we could even be possibly taking a step back from that high level mark. And so some of those disinflationary pressures of globalization are not really present. And so this is kind of like what we're finding when prices actually are when you need to hire domestically or when you're not in the constant state of outsourcing. So that's overall how I'm approaching it. And really kind of paying attention to fiscal stimulus, paying attention to wage and labor shortages and things like that. Another thing that's interesting is that, obviously, the CPI includes hedonic adjustments. And so if, let's say, cars, for example, if you bought a Toyota Camry 25 years ago, it was like, half the amount of money, right? So roughly doubled in that time, if I remember roughly correctly. But if you look at cars CPI, it's basically flat since then, up a little bit, I think. And the reason is basically because they said, okay, the car is twice as expensive, but it's also so much better than the older one. So you have better navigation, better safety features, better gas mileage, and certainly it's better. The question, obviously, quantifying how much better is a tricky thing. However, one thing I'm seeing now is that services are getting worse, but of course we're not doing hedonic adjustments to increase the CPI, right? So we're paying more money for services that are generally, less pleasant or less efficient than they were 2 years ago. But of course, that doesn't show up in the CPI. So it is, obviously it's always a challenge to manage a basket of measuring overall price increases. Mm-hmm.
So what is an example of some of these supply shortages that have had outsized impacts? You mentioned, cars. Would the semiconductor shortage be a good example of these shortages causing many downstream effects that are masking the inflation?
Semiconductors are a huge one because the place where it's showing up, I think the most obvious is cars, because it's like, that phrase, like, for want of a nail, like the horseshoe fell off, and for want of a horseshoe, like the horse didn't make it, the message wasn't delivered, and for want of a delivered message, like the battle was lost. There's like that old saying, and it's kind of like that with supply chains, right? So for want of like this, like, say a $5 semiconductor, Toyota can't finish their car. And so then there's a massive bottleneck in basically there's not enough new cars out there. And so that elevates the price of used cars, right? Because, people are sitting on cars and people need cars really bad. That pushes up the price until those people, just sell the car they don't need anymore. And then that even trickles through. So that impacts the price of platinum group metals. Because ironically, if you have less car demand, like demand for those metals from car manufacturers where they're heavily used, because you're temporarily reducing production because you have a semiconductor shortage, it basically trickles, through all sorts of weird things like that. And so I would say that's one of the biggest ones. We've obviously run into other ones earlier. We ran into that period of a lumber shortage, ran into other things. The semiconductor one's challenging because those are multi-billion-dollar advanced foundries, right? So those aren't ones you can just kind of snap your fingers and address overnight. Obviously, they can fix them eventually, but those are very costly. And there's a reason why there's only a handful of countries in the world that produce most of the advanced semiconductors.
Mm-hmm. Yeah, it seems like a very centralized but capital intensive production schedule, right?
Absolutely. And basically there's a number of countries that produce kind of medium and lower end semiconductors, but really the high end ones, there's only a few. And then it's also more concentrated in the sense that some of the machines required that those foundries purchase, there's really only a handful of makers of those machines as well. So from top to bottom, it's a pretty centralized space. And when you think of a semiconductor company, like people might think of NVIDIA, for example, a lot of those are fabless semiconductor companies. They don't actually make the semiconductor. They have one of those makers make it for them, after they've designed it and they've done all the kind of the pre-work. And so Taiwan Semiconductors is the biggest overall producer. And obviously, so that's got strategic importance with Taiwan. But basically, when every company in the world, or like a bunch of companies, are all going through this one giant semiconductor maker, that opens up all sorts of bottleneck issues. We don't really make semiconductors as distributed as you'd guess based on how many semiconductor companies there are.
Mm-hmm. I've heard that the semiconductor process is extremely energy intensive as well. And there's been recent guests that I've had that were highlighting the fact that the energy shortage could start impacting the semiconductor industry. So could that be another, another hoop to jump through, or another factor that could derail the semiconductors even more?
So I think it depends. I'm not a niche expert on this, on the, like the I guess the underlying economics of running one of those plants. But I will say, basically, if you look at aluminum, for example, aluminum is an extremely electricity intensive thing when you refine it. And so that's why it actually ends up in some countries that have a lot of abundant electricity, because it's essentially their way of exporting their extra electricity. They say, hey, everybody bring us your like aluminum ore, and we'll go ahead and use our abundant electricity to make it into aluminum for you. Now, we've seen reports, for example, in Europe, that some of those aluminum refiners have had to shut down temporarily because of those high electricity prices that they were experiencing. Now, semiconductors, I would imagine, I can't imagine shutting down a semiconductor because electricity costs are high, because you have a lot of pricing power there. And basically there will be suppliers saying we absolutely need those parts. But depending on how the contracts are structured, there's certainly people that know how those facilities work more than I do. But that would clearly be a priority to get those back online, perhaps more so than say aluminum, where it's a really kind of a more straightforward math problem there.
Mm-hmm. I guess the bigger question that I was asking there, Lyn, is that do you see this energy shortage causing bigger problems in the general economy as a real risk going forward here?
I think structurally, yes. Kind of a point that I've been making, I think, is that I'm both more bullish than most people on energy in the longer term, and maybe not as bullish as some people are in the near term. And what I mean by that is basically we saw a really big, energy shortages hit the headlines everywhere. The second half of this year, they're still over the headlines. We certainly have risk of more energy shortages. But when it becomes that consensus in that kind of near term,
right?
I think that there is some vulnerability to surprise to the downside. What if we have a mild winter, for example? There's things like that. But longer term, regardless of that happens, I don't have high conviction about energy over the next 6 months, because it's partially weather, it's partially human decisions, things like that. But I do think that structurally, looking out over the 2020s decade, we're going to be in a more energy scarce environment than the 2010s, basically because this, especially the second half of the 2010s, was characterized by overabundance, right? So we made a lot of unprofitable shale oil, which then got dumped on the market and basically pushed down global prices. Whereas we worked off a lot of that sort of excess supply, and we combine it with ESG mandates and things like that. I think we're kind of setting up ourselves structurally for more energy shortage. Now, I think eventually they respond to that, but that's not something you snap your fingers and do right away. So that can contribute. I mean, obviously those, hydrocarbons are used in a variety of things directly, and then they're also used to directly or indirectly power manufacturing places and things like that. So I do think that will have periods of leaking into the rest of the supply chain as we're seeing now. If you look at the long term kind of CPI, for example, or other ways to measure inflation, it's unmistakably correlated with energy prices, right? So because it's the master commodity underpinning most other things. Basically, it's really hard to get inflation without two things: wage growth and high oil prices, or high gasoline prices, and all that downstream stuff.
So, Lyn, I'd like to kind of dig into that a little bit more. How important is this distinction to you to be investing in fossil fuels or hydrocarbons versus these green technologies? Is there still a very important role for fossil fuels to play in the world despite the promise of wind and solar replacing it?
Well, certainly for the foreseeable future, for decades. And there's a couple ways to characterize that. Basically, that the world has never phased out a primary energy source. Every time we find a new energy source that's more dense than the one before it, we just kind of add to the prior energy sources. And those previous ones go down as a percentage, but not in absolute terms. And so when we used to use biomass, then we started using coal, but we never stopped using biomass. The world uses as much biomass as we did 300 years ago, partly because there's more people, right? That's actually mainly why. So each, on a percentage of our energy, it's less, but we still use a ton of biomass. Then we discovered oil and gas, and coal kind of eventually kind of leveled off, but we don't really dial down how much coal we use. Now there are some niche energy sources like whale oil, for example, that get phased out of use. But basically, when we build our civilization on top of an energy source, that is very, very slow to go away. And then when you look at wind and solar, they have some challenges. So obviously they're very good for adding to part of a grid in certain regions, right? So if you have a windy area, if you have a sunny area, they can be useful additions to a grid. The challenge is that when they get to a very high percentage, the grid becomes subject to cloudy days or windless days. And so you need one of two things. Either you need to fall back on fossil fuels anyway, or you need storage capability, which is getting better over time, but it's not like one of those things like Moore's law where it just gets better exponentially. Battery technology is actually, for decades, it's been a very slow growing, slow improving thing because we're dealing with like material science here, real world physical constraints. And then even if you make really good energy storage, you can imagine how much metals would be required to do grid level energy storage everywhere, right? For like say half of every grid everywhere. And so there are a lot of long-term challenges for making those, anything resembling a very, very high percentage of a grid. And so I think that it's not surprising that we're seeing an uptick in interest in nuclear. So I've been talking in my research about the benefits of nuclear for over a year now. And it seems like, some of the policymakers are kind of catching on to that. So I think nuclear has a promising future, especially if they start using 21st century tech rather than, 1960s, 1970s tech. So I think that's a promising area. And I think that solar and wind will probably grow larger than they are now. But they're not really a good foundation for a grid unless we have some utterly massive material science breakthrough in terms of storage for cheap, and it doesn't use a lot of finite resources.
Right. So, Lyn, you've written before that there are parts of the world that are not seeing inflation like we are in the US. So what are the causes of this?
So it's partially spread out, but it's also partially not. So we are seeing inflation in many places, but it's certainly not uniform, right? So it's not like, basically if demand increases so much in the United States that basically we soak up a lot of, say semiconductor demand, you're going to get inflation for those same things in other countries as well, because it's a global market. And so overall, what we're seeing is that there's, so far inflation has been pretty hot in the United States, more so than say Japan. And it's in large part because, we did more stimulus, meaning that our broad money supply, our M2, grew a lot faster than Japan's and many other countries. And so we in some ways had a larger mismatch between supply and demand than many of those other countries. But like I said, that gets kind of mitigated by the fact that some markets are global, and therefore when it comes to commodities or comes to semiconductors, many places are experiencing inflation, and many places also did stimulus, just not as large of a percentage. So we are seeing a big difference in inflation. It's partially tied to how much stimulus they did. Emerging markets are always, kind of a different matter because they can also experience inflation just because their currency is weaker, not necessarily because they did fiscal stimulus. And so they've actually taken more action to, say, tighten their monetary policy, actually raise rates, whereas developed markets have just, they've gotten less dovish in some ways, but they've not really been hawkish at all.
Mm-hmm. So in your latest investment letter, you make the case that value stocks have started to make a resurgence. So why do we typically see a shift from growth to value when we get a recession and a fundamental shift in fiscal and monetary policy?
So generally, if you look at the long-term history of growth and value has outperformed more often than growth. But there were two really big exceptions, and those were the 1930s and the 2010s. So those are periods of very, very slow growth. And so people poured into, the smaller number of companies that were actually still growing in that difficult environment. They were just secular growers. They basically new technologies or new things that just were growing despite a weak economic environment. So in the 2010s, that was like the FANG stocks, for example. And so those 2 decades were characterized by extraordinarily strong growth performance over value. And then if you look also, generally this growth to value kind of shift tends to happen around recessions with big changes in monetary policy. And it doesn't necessarily mean that value begins outperforming growth. It could be the opposite. It really depends on what's happening in that environment. So going into the savings and loans crisis of the late 80s and early 90s, value was outperforming into that period, and then that kind of marked the turning point. Because obviously a lot of the issues that places they ran into issues were value oriented, like the financial sector. And then during the 90s, you had this huge, obviously, growth bubble going into .com, and that peaked in 2000, 2001, rolled over, and then you got this long stretch. You had a minor recession. Then you had this long stretch of value outperformance going into the subprime mortgage crisis. Then you had that big reversal, that big change of policy. A lot of the banks blew up. A lot of that was, oil companies ran into issues like commodity companies, all these kind of more value-oriented areas. And instead, those growth stocks, those FANG stocks, did very, very well. And so generally, we see that the market that we're in kind of extends until we kind of say squeeze all the juice out of that orange, right? So the valuations of that factor become very, very high, right? So going into the subprime mortgage crisis, bank valuations were very high. Going into the .com bubble and going into this period now, growth stock valuations are very high. So one is you basically get all the money you can out of them in terms of valuation, and then they basically there's tons of malinvestment at some point in that space. And when you have recession and you have changing fiscal monetary policy, that generally starts to reverse. And some of those things that were kind of left for dead that are actually pretty cheap start to become more attractive. And some of those things that have basically driven this whole latest credit cycle and that are very expensive generally start to underperform. And so my, kind of observation is that we're seeing initial signs of that for growth to value. Nothing fully confirmed yet, but basically we've kind of hit a high watermark where, growth stopped outperforming value, and it's kind of been going in this like sideways consolidation. And it'll be interesting to see if we break up and growth just keeps outperforming, or if that, in some ways did mark a kind of a change in factor performance. Obviously we're seeing the energy shortages and some of these other commodity shortages, things like that are generally pretty good for value-oriented sectors.
So what does the value sector need to continue to keep appreciating versus the growth sector?
Generally higher nominal growth. So that can include that significant inflationary component. Another thing that generally benefits value over growth would be, a consistently positive yield curve and potentially higher long-term rates. Because obviously banks, they directly benefit from that. But also growth stock valuations, as high as they are somewhat more sensitive to long duration treasury yields because they represent an opportunity cost, right? So tech stocks can be thought of as very, very long duration assets, arguably the longest duration asset around. You're betting on something basically taking off over the next 20, 30 years. And so when the cost of money is, say, 5%, you're willing to pay less money for that long runway of growth. Whereas when the cost of money is 0%, 1%, 2%, you're willing to pay up tremendously for that growth stock because your opportunity cost is so low. So generally in a rising yield environment, you'd often want to be more value inclined, and in a lower yield environment, generally signaling less growth and cheaper kind of perpetual cost of money, those growth stocks generally do surprisingly well. And obviously that will depend on the company by company specific, but those are some of the trends. Basically, the 2010s was characterized by low yields and slow growth, and commodity abundance, which helped push inflation down, for most of that decade. And so that was a perfect environment for that growth outperformance. But if you do start to see, rising commodity prices, that obviously benefits some value stocks directly. But then if that translates into inflation and then potentially in the longer end, somewhat stickier, higher yields than we saw in the say the 2010s, or at least they stop going down, right? So they just start going sideways for a while. So growth stocks generally maybe get less, they stop getting more expensive and they just kind of stay at whatever valuations they are. That can kind of rotate some of that growth to value perception.
Mm-hmm. So when we think about the cost of money, and we're looking at going into the end of the year here, what do you think the chances are that Powell stays chair of the Fed, and what are the, let's say, the downstream effects if we get a chair that is even more dovish?
So there are people politically tied in more than me that probably can give you better odds of who's to be the Fed chair in a few months. So I'm watching that, but I don't really have a strong prediction on that. I guess is how I'd phrase that. Now, depending on who, what the overall makeup of the Fed is. So it's not just the Fed chair. It's the overall kind of makeup of the committee that chooses monetary policy. I think it's going to have a somewhat less effect than people think, and that it's instead more about fiscal situation, right? So, the Fed, I think they're going to be able to partially taper here, right? So they're going to reduce their asset purchases because, as we see from the reverse repo market, there is a lot of demand for T-bills. Now, the Treasury might have to lower their average duration of their treasuries issued in order to tap into that shorter term, demand for those treasuries. And I think they might have issues with, say, the longer end of the curve. But so I think that for a period of time, regardless of who's running the Fed, they'll be able to taper. I think the big difference could come down to what happens when the economy slows, what happens when you run into trouble. Powell kind of started out a little bit more on maybe the center hawkish side, and has clearly drifted, more dovish over time as he ran into the Powell pivot of 2018. Then he ran into the shutdown crisis of 2020. And he's, end up being, the most dovish Fed chair we've had. There are obviously, other leading candidates like Brainerd that would be considered more dovish. You could basically would raise the odds of seeing something like formal yield curve control rather than just informal yield curve control. And it basically, I think, can leave open looser monetary policy for longer, potentially, which all else being equal is better for asset prices and but doesn't necessarily affect the real economy as directly as fiscal stimulus or lack thereof, and some of those other factors like energy shortages and things like that.
So when we think about how inflation occurs, Lyn, what are some of the factors that are different now versus the 1970s that determine the strategy of raising rates, not working now versus the way it did back then?
So I often compare this period to the 1940s rather than the 70s, because even though there's some takeaways from both, the overall kind of fiscal situation looks more like the 40s. And what I mean by that is, if you look at the 70s, debt as a percentage of GDP was very low. It was some of the lowest that the country's had over the past 100 years, because we basically, from the 40s, 50s period, we already inflated away a lot of our debt, and basically we grew nominal GDP faster than at a higher rate than Treasury yields. And so basically, Treasury spent the better part of 4 decades being a pretty poor investment. And so by the time we got to the 70s, debt as a percentage of GDP was pretty low. And so Paul Volcker was able to raise rates dramatically in order to basically stabilize the dollar. And so they were able to put the economy into a recession, reduce demand, basically show the world that they want positive real rates for treasuries and basically overall kind of financial institutions in the U.S. And that kind of helped stabilize things. And it didn't render everything insolvent because debt was pretty low, especially on the sovereign level. Now, if you go back to the 40s, the part of why we had all that inflation in the 40s was that governments around the world were doing large amounts of fiscal spending for the war, which of course, if you look at how that spending is most of it's domestic ultimately, right? So it's basically building those factories, hiring those people. When they come back from war, you give them the GI Bill, right? So they go to college, they get training, they get assistance with a mortgage, whatever the case may be. And so a lot of that's domestic spending, and that ends up being pretty inflationary. But because debt as a percentage of GDP was so high, right? So that was the last time that debt as a percentage of GDP was high as it is now, the only time in U.S. history. The Fed just said we can't raise rates, and in fact, the Treasury basically partially merged with the Fed and said you can't raise interest rates. I mean, this obviously we have a war here, and so they just held rates at zero practically, for 9 years, despite the fact that you had 6% average inflation during those years, and that sometimes inflation peaked at 19% year over year. It was kind of this big choppy environment for inflation. And so as a result, if you were holding treasury bonds or treasury bills, you got massively devalued because you were holding these things with almost no yield while inflation ran very, very hot. And so overall, because our debt is so high, I view this as being more like the 40s, where they're not going to sharply raise rates. Maybe they could put some 25 basis point rate hikes here and there. They can gradually raise rates potentially as long as they're well behind what's happening with inflation. And so those treasuries just keep perpetually getting inflated away, or at least partially inflated away, because you're in this environment of kind of structurally negative real yields. So there are takeaways from the 70s as well. Like I think energy, more closely resembles the 70s. I also think equity markets. I think that the late 60s, early 70s can tell us a lot about equity markets because those were very, very highly valued times going into that period. Whereas going into the 40s, equities were cheap. So there's certainly things I can learn from the 70s, but I think in terms of overall fiscal monetary policy, the 40s represent, perhaps our closest analog, but even that's not perfect.
So considering an inflationary cycle, can we see deflationary pulses in certain sectors as part of this cycle?
Yeah, I think so. Even if you look at the 40s and the 70s, we think of those as inflationary times, but they weren't a straight line. Mm-hmm. Partially they tried, wage and price controls, but also just because there were different attempts to, tighten and basically cool off. And then when it basically cool off too much, then they would, let that go again. You'd have another round of inflation. So if you look at both those periods, there are these waves of inflation and then disinflation. Now the 70s had more sticky inflation than the 40s, a little bit less kind of spiky inflation. But overall, they both were, neither of them were straight lines. And so overall, I think the 2020s are going to be similar, where you're going to have periods of time where inflation cools off, or to some extent, and then that people say, oh look, it was fully transitory. And then we have, like, say, another round of fiscal and another round of inflation, or whatever the catalyst ends up being. So that's my overall base case. So, if we say, I can imagine scenarios, for example, we stop doing fiscal stimulus for a couple of years, and then the economy starts decelerating, then we kind of inflation levels off and cools down. In addition, if you have any sort of shock, because there's so much debt in the system, you can get a kind of a disinflationary kind of spike that happens pretty quickly. If the dollar spikes and then emerging markets kind of get tightened because of that, and then it kind of trickles back into maybe forced selling of treasuries like we saw in March 2020, there are ways you can get these kind of disinflationary pulses that happen. So overall, I think that there's still a usefulness to have some dry powder, to have maybe some short-term tips, for example, that you could rebalance into your preferred assets, when they have those corrections. So it's not like I think we're just going to go in a straight line all the way up to 2030 and just inflation's never going to change. It's just going to be super hot that whole time. I think we're going to probably go through cycles, but obviously it will depend partially on policymaker decisions and other factors that are hard to predict.
So considering these different pulses, that it's not going to be a straight line, should investors also be more mindful of the time horizon when they're thinking about where to invest in this environment?
I think so. And I think, it's one of those challenging, obviously every investor has to determine really their individual time horizons. So some people like to do position trade, right? So the whole thing's for years or at least months. Other people like to swing trade or change things more frequently. But obviously most people shouldn't be active traders, right? I mean, that takes a lot of time. Your odds of outperforming what you're trying to trade against are low, especially when after you include taxes. So for people that aren't professional traders, I think it's obviously good to have a very long-term view and acknowledge that, because rates are so low, we're all kind of forced into these riskier assets, right? Because we can't, hold a ton of cash, it gets devalued. And so we're all kind of essentially monetizing other assets, right? So we're adding a monetary premium to other things because we want to own them, not just for the utility, but also because we'd rather own them than cash. And the risk there is that you get overvaluation and you have to deal with higher volatility. That's kind of the trade-off that you face. And so I do think people should focus, on valuation and also on basically euphoria, right? So when something goes up dramatically and then you pile into it, even if that ends up being a good investment over the next 10 years, that could do very poorly for 3 years because you bought into a big spike, for example. So that kind of goes back to my thing on energy. I think I'm just kind of holding energy, long term, and just kind of setting expectations that I don't necessarily expect this to double next year. It could just chop along and do its thing. But basically, when you look into the dividends that many of them pay and the overall value that you get in that industry compared to some other industries, it's certainly a place that I like to be overweight when looking out 5+ years.
Mm-hmm. I'd like to go back a little bit to kind of the CPI picture that we were looking at. Is rent inflation a major variable that hasn't been properly accounted for yet?
So I would say it's just starting to be accounted for. So if you look at the early, if you look at earlier in 2021, the first half, let's call it, we started to get this inflationary spike. Now, part of that was base effects, and then also part of it was measurable inflation. But interestingly, overall, owner's equivalent rent and rent inflation was still super low, at least in the U.S., which was what I tracked most closely. And so that inflation was happening without that big component, which, depending on which inflation measure you look at, is like 30 to 40% of the overall basket. And then we started to see basically home prices soar, but those official measures of housing inflation lag that and smooth that out a ton, right? And so we didn't really see it show up there yet. But something I've been tracking since around the middle of 2021, and that's really kind of starting to kick in now, is that those rent and those owner's equivalent rent measurements are going up now. They're basically catching up to some extent slowly with the the big increase that we've seen in housing prices and overall real estate prices. And so now that basically some other areas may be cooling off, that overall housing component is what's driving it now and keeping it pretty sticky. So whether or not it drives it higher or whether it simply prevents it from coming down, remains to be seen. But I think that basically for at least the next 2 quarters that I have visibility for in terms of this kind of rent and owner's equivalent rent situation, that looks very sticky for higher inflation, basically going into, say, the middle of next year.
Mm-hmm. So how does gold fit into your thesis here? Does it surprise you that with the inflation that we have seen, that gold hasn't gotten more of a bid than it has over the past year?
So I think the last couple months were a little bit surprising. And so I kind of separate it into 2 phases. So from, where gold peaked in August 2020, and then kind of went into a big correction. That part was not surprising because we basically saw that real yields, they stopped decreasing from that point as measured by the TIPS market. In addition, you had pretty high euphoria in that kind of, period. And so I warned in my newsletter, for example, I was like, I'm still structurally bullish on gold, but I think it's, could very well take a break here. Bitcoin might be, kind of star of the show for a period of time. We've seen that. Now, where I was a little bit surprised was around that kind of March period, we started to see some bottoming signs of gold and gold stocks. And so I got a little bit more constructive on the space again. And we started to see, pretty good rally in April, but then it just rolled back over. And it's been, this sideways chop ever since, kind of sideways to down, kind of pretty weak price action. And so I think that was somewhat surprising, at least to me, to see how, kind of how weak it's been. And I did kind of eventually think that overall Bitcoin was probably a big chunk of that. So if people ask me in late 2020, do you think Bitcoin is stealing some of the liquidity out of gold? I would say it's not really big enough to matter. I don't think so. Gold's kind of behaving what I'd expect from real rates. But I would say that in 2021, Bitcoin's gotten big enough, and I am seeing signs that basically some of the gold liquidity has gone into Bitcoin instead. And so I think that in some ways, gold makes more sense when you combine it with Bitcoin, right? So if you looked at the market cap of gold and Bitcoin, that makes more sense with what's happening with inflation compared to just looking at gold alone, because people don't just have one kind of scarce money they can go into. There's a variety of things they can go into now, which is kind of diluting the whole space. So that's how I'm approaching it. I'm still bullish on gold for the next few years as a base case, because I think we're going to be in this period of structurally negative real rates. And if the bond market starts to wake up to that more, there's a lot of capital that could flow into, say, gold and silver that maybe is not on board with Bitcoin, for example. And so I'm kind of seeing how that's going to play out. I like to own both.
Do you think that part of it could be that there are a lot of investors that believe the transitory narrative that has been laid out?
I think that's part of it for big pools of capital. And it's interesting that gold follows the tips market more so than the actual CPI, for example, or even other measurements of inflation. Mm-hmm. So the fact that real rates are super negative now when you look at CPI, gold doesn't really care too much. Instead, it looks at the tips market that is basically measuring inflation expectations over the next X number of years, depending on which type of treasury it is. But of course, those are influenced by the fact that the Fed is buying those tips and buying different types of bonds in general. And so gold is somewhat of a more financialized market. And so it basically, I think overall, if more pools of capital were to kind of panic and realize that this isn't going away anytime soon, and that some of their yields are basically going to be underwater for many years, I think you could see more of a flow into those spaces. And it's obviously it's hard to say how much would be captured by Bitcoin, how much would be captured by silver, how much would be captured by gold. But I think there would be a general shift towards those types of assets.
So in the article, you make the distinction between cyclical value and defensive value sectors. So could you explain the difference to us?
So when we think of growth stocks and value stocks, there's multiple sectors that are generally in each of those categories. Now, there's no hard definition of what a value stock is. Generally it means a cheaper stock where it's less about growth, more about kind of, returning capital to shareholders, paying a dividend, just running a stable business that might be growing moderately, might be going sideways. But basically it's cheaper and shareholders being rewarded with that capital. Now that value stocks can exist in any sector, right? There can even be tech stocks that are value stocks, but generally you find more of them in certain sectors, right? So financials, healthcare, energy, places like that. But even there, you can't necessarily group them all together, because we can divide them into defensive sectors, defensive value. That'd be things like healthcare and utilities, where they're rather resistant to recessions. They basically don't have that boom bust characteristic as much. Whereas when you look at cyclical value, that's things like banks and energy and commodities, where and industrials, arguably, where you have these kind of big ups and downs, and they're very, very economically sensitive. And so when people look at growth to value, it can really help to separate defensive value versus cyclical value. And I think I referenced the top-down charts team there, because they have some great charts on separating those two sub-factors.
So Lyn, when you think about let's say which bucket Bitcoin fits into for you, do you look at it as a growth or a value play, or in a way, does it kind of straddle both?
I view it as straddling both, and in some ways I view it as kind of gold and a tech stock combined. So on one hand, you're investing in the idea that this technology will probably continue to take market share in some ways. There's ongoing development around the ecosystem. There's ongoing development on layer 2 technologies. There's still upgrades happening even on the base layer, like Taproot, for example. So basically, you're getting this kind of technological S-curve adoption. But on the other hand, it's also, now that it's big enough, people view it as partially an inflation hedge. especially because it's not just the US. I mean, there are countries that have 20, 30, 40% inflation right now. And many of those people go and they buy Bitcoin as part of their holdings instead if they can access it. And so overall, I view it as it's got that monetary aspect of gold, but it's also a tech stock. And obviously, it's very different kind of risk reward than gold, because gold is obviously this 5,000 year established store of value, whereas with Bitcoin, it's 13 years old, and you're investing in the basically the probability that it's going to continue to monetize and reach whatever total addressable market that it's going to reach. So they're two rather different approaches, but I think that they somewhat kind of benefit from each other in a portfolio, right? So the periods of time where gold could do better, there are periods of time where Bitcoin could do better, and it depends on how much volatility someone wants in their portfolio.
So why do you see holding a sizable Bitcoin allocation as preferable to holding any tech stock?
Because I think over time, I think when we look at tech stocks now, especially FANG stocks, many of them are not rapidly innovating anymore, right? So they've reached a very dominant market share, and I think they're kind of eventually slowly going to transform into value stocks that are already very expensive. And so there's that aspect. And then if you look at growth stocks in general, many of them are just extremely highly valued when you compare them to revenues, when you compare them to earnings. And those aren't scarce, right? So if they're highly valued, the CEO can issue more shares of that company to raise capital and try to grow faster, right? So you're buying into something that you're putting a monetary premium on something that is not scarce. Shares of a company are not scarce. Whereas Bitcoin can get larger than any individual company because it's not tied to earnings or revenue. It's basically being measured as its usefulness as money. And essentially all monies are just kind of ledgers that we have a reason to believe are secure, right? That no one's going to just add to, no one's going to take ours away. And so when we're kind of looking out, at Bitcoin's adoption, I think it's earlier on its adoption curve than many of the large tech stocks today, and because it's like total number that exists cannot adjust to demand, right? So it's not like the CEO. There's no CEO of Bitcoin that can say, "Wow, there's so much interest in Bitcoin. Let's go ahead and make another 5 million Bitcoin to satisfy all this demand for our stock." Like say that you can do it Tesla, you can do it any of these other types of growth stocks, whereas with Bitcoin you can't. So because it's a monetary good, it's kind of used as collateral. In some countries, it's used as money. Because there's that global demand for it, and because it doesn't have a kind of flexible supply, it's somewhat of a different basket overall than tech stocks. And I've been kind of in that weird camp of being more value inclined and also Bitcoin bullish, whereas often you see people that like Bitcoin also generally like the Teslas of the world and the growth stocks of the world. Whereas there are a handful of investors out there that are more concerned about high growth equity valuations, right? But then also bullish on Bitcoin because they conceptually put them in a somewhat overlapping but different bucket.
Mm-hmm. So what are the risks with Bitcoin right now? Considering the last time it hit an all-time high, it pulled back fairly dramatically. And since we've seen the advent of a Bitcoin ETF, does this show that the SEC looks favorable towards Bitcoin? And does this generally add to the bullish case for it?
So yeah, the Bitcoin ETF itself is not something I would buy because it's futures based, and I generally don't like futures based commodity ETFs. But what it does signal is that the SEC is more open to it. I mean, we've heard, for example, the SEC chair has referred to Bitcoin as a useful invention. He's been more critical about other types of crypto assets that more closely resemble securities, whereas Bitcoin is classified as a commodity. Because it doesn't pass the Howey test of being a security. And so overall, I think we're getting more signs of favorable treatment to some extent, at least for Bitcoin. And that signals to large pools of capital that it's somewhat safe to buy in the regulatory sense. Might not be safe in terms of price, but it's somewhat safe in terms of regulatory clarity. And so smaller investors didn't care about that. I mean, they wanted to buy it regardless of the SEC's opinion. Whereas large pools of capital, I mean, they can't invest $1 billion into something and then be told the institutions can't own it or something like that, and have to sell at unfavorable time when other institutions are selling too. So the more regulatory clarity they get from the Fed, who basically said they have no intention to ban crypto, that was Powell's statement, and then when you get more clarity from the SEC, that tends to be helpful. There's still somewhat lack of clarity from Treasury and Congress around the issue, but now they're even Bitcoin bulls in the Senate or in the House, for example. And so overall, I think it's kind of reached a point where it's got some level of critical mass that I think is that these more institutional types of capital are interested in. So the risks going forward, I would say one is just obviously Bitcoin is very volatile, right? So, Bitcoin could be between the time of saying this versus the time this is published, this could be Bitcoin could be down 20%, right?
Mm-hmm.
More even. It's a very volatile asset still. It's kind of finding its total addressable market. We obviously saw more than a 50% correction earlier this year, something between 50 and 60% down from its all-time high, and so it's a very volatile asset. And so I think the main risk is kind of managing that volatility with a position size that makes sense for you. There's some other risks, obviously it's gone through regulatory challenges in China and other places. So it's more of that global game theory where one country could ban it, but another country can open up to it. So we've kind of seen different countries approach it differently. We saw India, for example, was weighing the possibility of banning it, right? So their central bank cut off the financial system. The Supreme Court overrode that. Then it was being talked about in Congress to maybe ban all ownership of it. And now that never went through, and now that's kind of being reconsidered, right? So countries are flip-flopping on it, but there's still, there's some countries there's regulatory lack of clarity, and then also, I would kind of describe it as sort of a denial of service attack, where whenever Bitcoin does well, many of these other altcoins do very, very well, and that can eventually kind of help end the bull market, because even though you can't make more Bitcoin, you can make tons of these other altcoins. And it kind of helps, saturate demand for that cycle, and then it rolls over, and then all those projects, the vast majority of which are useless, the liquidity drains out of them, eventually finds its way back to Bitcoin, and then this cycle starts anew, right? So I think there are a couple key risks to look out for, but most of them are manageable with position size management.
Right. Excellent, Lyn. I think we've covered a lot of ground there. Is there anything else you'd like to touch on before we wrap up here?
I think that's the main thing. I think a key focus I'll have for years, I believe, is on energy policy. I think it's gonna be a really important thing to watch, because the degree to which we have energy shortages or lack thereof will be very important for overall inflation, which is then very important for all sorts of different policies and different asset classes. So I think watching the energy environment is going to be more important in this decade than the prior decade, both in terms of say the possibility of higher energy prices and more scarcity, but also times where that could be the opposite for a year or 2 years, where you're starting to get signs of abundance, right? So I think that energy policy overall is going to be a much bigger factor this decade than the prior decade.
Excellent. Lyn, your website is a real treasure trove of information. You write a lot of really interesting, really in-depth articles. That's available at lynalden.com. And of course, you're available on Twitter as well at Lyn Alden Contact. Anywhere else you'd like to point to?
No, I think that covers it. Yeah, we put out free material. My Twitter obviously is accessible, so people can find it. And thanks again for having me on.
It's always a pleasure to speak with you, Lyn. Thank you so much for your time. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.